So why don't most people do well in options trading? Well, in today's video, my goal is to help you guys not fall in that category. I put down a small guide as to what concepts you need to be learning in order to not fail in trading options. Let's get into it. What's going on, guys? My name is Usman Ashraf. I've been trading options for almost 10 years now, and today I'm going to provide you guys with a key guide as to what topics and concepts in options are the most important concept that you guys need to be focusing on. And also why most people fail so miserably in trading options. First of all, a lot of people approach options in a very wrong mindset, right? They look at the profits from other people on social media and they just simply start trading right away. And it's very easy to get into trading. All you need to do is open up an account. You have to be over 18 years old, and that's pretty much it. Now, you have an account, you put money in, and there you go. Now you can start trading. My approach when I first started trading was I started with trading shares, which was biotech penny stocks. I learned key concepts such as how to find key levels, the relation between price action and volume, supply and demand levels, reading level 2, time and sales, how price moves in between levels, pretty much all the basics. And after a couple of months, I came across options, so I switched over because I liked the way that I can risk less and make a huge percent return back. Now, keep in mind, by the time I switched over, I already had a little bit of experience in the market. Now, I was nowhere near a pro trader, but I knew how to find the basics that I mentioned earlier. Now, when I started trading options, I thought all I had to do was, if the stock is gonna go up, simply buy calls. If the stock's gonna go down, simply buy puts. And boy, was I wrong, right? Because when you're trading shares, there's no time against you, there's no implied volatility. You just set a certain stop loss and that's it. That stop loss can work with almost every single strategy. 5% away, 7% away, 10% away, depending on your risk, of course. In options, you can't have a same stop loss for every single trade. And I'll get more into that why later on. Don't start typing comments like, hey, no, that's not it. Give me a second to explain. So first, let me give you guys 2 examples as to why most traders who jump into options, they don't do well. So the first example is gonna be stop losses, just like I was just mentioning, right? Now, if you get into a stock that is trading at $1 and you have a conventional stop, which pretty much almost everyone follows, let's say 5 to 10%. If the stock goes down to 90 cents, your stop loss is triggered, you exit the trade, right? So if you're day trading, swing trading, whatever the case is, you set it based on a certain percentage and it should work across every single trade setup, right? But in options, your stop loss will depend on many factors, such as your strike selection, your expiration. But in options, your stop loss is going to be dependent on 2 very important factors. The first one being your strike selection, all right? So what is your strike? Are you trading out of the money, in the money, at the money? So based on that strike selection, your stop losses are going to vary. And second is going to be your expiration. Now remember, when you're buying shares, there is absolutely no expiration date, which means if you get into a stock, it goes below your stop, you can hold it for until that company doesn't go bankrupt, right? If the stock price goes from $1 to 80 cents back to $1, you'll break even. With options, because there's time involved, we can't hold those positions for that long. So since we can't hold those positions for too long, our stop has to match with that expiration. So sometimes 5%, sometimes 10%. And if you're trading 0 DTE, then a lot of times you have to give your stop loss a little bit of a gap. So 5-10% on 0 DT is gonna be triggered very quickly. So you might have to go with 20%. So let's say that I'm gonna trade, my expiration is set to 2 weeks out, and I just get in, my strike is at the money. At that particular point on a 5-minute time frame, setting your stop loss under 9 EMA makes sense, right? Because if it pulls back, majority of those strikes are not gonna lose more than 10, maybe 15% value. Now, if we focus on the same exact trade and change 2 components, one is your expiration, rather than doing 2 weeks out, we do same week or maybe 2 days out expiration, and our strike is 3 to 4 strikes out of the money. Guess what? Now, if you keep the same exact stop, that 5, 10, or maybe 15% stop could be 30%, meaning if the 9 EMA is hit, that means that that loss could be much, much more. And it's simply because of us changing a small component of our trade, which is the strike and expiration. which again is not the same as when you're trading shares. Now you're probably thinking that doesn't make sense because that's not what we were taught. We were taught that if a stock pulls back a certain amount, you're only gonna lose a certain percent on that trade. But see, with options, we have so many components working against us at times, such as the time factor, implied volatility. These two things are going to be constantly working on crushing your premiums. So there's basically no universal stop loss in options. It really depends on the strategy that you're implementing. So this is one of the biggest things that I've seen why most traders end up failing in options, because they don't understand that it's not the same as trading shares when it comes to placing your stop. Let's talk about the second most important thing, time. So when we buy shares, there's no clock against us. Like I mentioned earlier, you can hold as long as you want, but when you're holding options, every single option contract has an expiration. I'm pretty sure you guys have heard of 0 DTE. Those are contracts that expire that particular day. Hence, they tend to pay the most and lose value the fastest. Then there's weekly, bi-weekly, monthly. So pretty much every single Friday, the weekly contracts expire. So if you take a trade on Monday for that week expiration, that means you have 5 days until those contracts expire. So if you buy a stock that's trading at $1, you have a stop loss of, let's say, 10 cents, it pulls back to 92 cents. Now you will hold up until that 10 cent is triggered, right? So that 10 cent stop loss is gonna be at 90 cents. So if it stays over 92 for, let's say, 3-4 weeks, no biggie, right? You can keep holding that trade, starts to go back up, boom, we're back to green. Once it goes to $1.10, now you can either cash out or you can keep holding. Now, if we were taking that trade on options, right? So let's say you have 2, 3, 4 week out expiration, the stock pulls back, same manner, you lose a certain amount, and let's say the stock stays at that level every single day. What happens is time is working against us. So every single day, by the end of the day, there's something called theta. That is slowly taking away from your premiums. So every single day, you're going to be losing a certain amount. So if the stock stays in that range for too long, that 10% stop loss is probably gonna get triggered in 2 or 3 days. So again, it puts us in the same dilemma. Stop loss, time. These are both things that end up ruining your trade. So these were just 2 examples that I went over. There are a ton of other examples that I can go over based on your strike selection, your expiration, the strike that, how far you're going, how deep in the money you're going. All of those things are going to have a major impact on your trading. So now you're wondering, how do you fix this? First of all, you need to start learning each one of those concepts in depth. And I'm not talking about just reading one paragraph about it and that's it. No, you want to learn as much as possible as you can on those topics. So I'm going to give you guys a small guide as to where you want to start. And I'm assuming you already know what calls are, what puts are. So the first thing you want to focus on are the Greeks. So the 4 Greeks that are important are delta, gamma, theta, and vega, right? So these are what make up the option premium. The next thing you want to look at is how does the time and implied volatility applies to your option premiums. This is where you look at something called the intrinsic value and extrinsic value. These 2 components price out your option premiums. So Greeks cause a change in your premiums. Intrinsic and extrinsic value is what option premiums are made up of. Then you have implied volatility, right? So this, depending on how volatile the market is, your premiums are going to react more aggressively. They're going to be priced more aggressively or much cheaper. Next is going to be time decay, which also falls under one of the Greeks, which is called theta. These are just the basic concept. Once you get understanding of these, then you can start diving into more advanced topics such as 0 DTE. Those are 0 days to expiration contracts. They tend to lose value a little bit faster. They have higher gamma. Their returns are much faster, but they also take away from your premiums much faster also. And as you guys dive deeper and deeper into these concepts, the last and most important concept is going to be how your strike and your expiration, the correlation between the two, right? So if you're trading on Monday versus Friday at the money contracts, how are they priced differently? You have on Monday, you have 4 days, 5 days till expiration. On Friday, they're expiring the same day. So an option premium at the money on Monday is going to be, let's just say $5. On Friday, that same premium is going to be $1. Now, when you understand that why those premiums are priced differently, your approach is going to be different. Meaning, if you're buying 2 contracts on Monday, your position size is $1,000. On Friday, your $1,000 position size can get you 10 contracts versus 2 contracts on Monday. So on those days, you want to start sizing down slightly. So if you're wrong, your losses are not as aggressive as they should be if you're going in with a higher position size. So this video, I just kind of wanted to give you guys a better guide as to what you should be searching for, what topics you should be focusing on, so you don't fail like majority of these other traders that are failing in options. Now, if you guys want me to make an in-depth video on the concepts that I just mentioned, leave a comment below. Let me know what concepts to discuss, or if you want me to make a full options trading basic breakdown, let me know and I'll make that as well. Just comment below and I'll see you guys in the next video.